to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com.
Hello and welcome to our next instalment of Nucleus Insights. And today we're looking at the Australian dollar and the potential of a reflation. So let's jump into it. Anyway, we've got our agenda for today. We're looking at, well, first actually we're going to start with a quick recap on our Aussie dollar theme from a prior webinar. So we'll just sort of cover off on where we finished up last time and how that reflects back through into in today's presentation, and then we'll jump into the agenda. So today we've got we're looking at the 5 essential drivers of our valuation model: Chinese growth and Australia's terms of trade, the interest rate differentials, investor sentiment and technicals, the relative strength of the US dollar. Then looking to the future with emerging markets, the emerging markets crisis, and then finally, of course, reflecting back on how we use these themes every day in the investments at Nucleus Wealth. So with no further ado, I will hand over to our Chief Strategist, David Llewellyn-Smith, to run us through a quick reflection on where we finished up last time we looked at the dollar. Welcome, Dave.
Thanks, Tim. It's good to be here. Good to be back live. So, revisiting May when we last looked at the Aussie, I'm just rereading what we said, and we said the world was reflating on a falling US dollar, a monetary tailwind for emerging markets and commodities. Mid-year, this will run into a fundamental headwind as China slows. If terms of trade and the negative interest rate spreads fall, then the AUD will crater. So that's pretty good.
Well done.
That's more or less what happened. So that gives us a sort of starting point on why the Aussie was falling, which was the 2 main drivers, which are terms of trade was, actually the terms of trade held up, but China's growth was coming off and markets were getting quite worried, overlaid by the trade war, of course, and the interest rate spreads to the United States and the US dollar were getting more and more negative. So basically the things that we forecast happened, so that was good. And so those make up they're sort of the 2 main components of our 5 driver model for AUD fair valuation, which is where we'll go next, and we'll revisit what we did in May, which is look at those 5 drivers and see what that says about the outlook.
Okay. And I guess the important thing to note is that things have changed, and so don't just listen to the old one and switch off, because we do have a number of sort of changes to our views.
Okay, yeah, fantastic. And obviously there has been given the fall, we need to now look at the reasons behind it as we're going to go through today, and I guess where it's headed. So let's jump into it. So we've got here the Australian dollar 5 drivers. So we're kicking off with Australian global growth, and we've got a lovely graph chart there, rather, of the China broad credit.
Yeah, this is my favourite chart, which anyone who's seen me speak will have seen this 100 times. But it's probably the most important chart for the Australian dollar that there is, and that is it's Chinese broad credit. So this is the leading indicator, the best leading indicator we have for Chinese growth. That includes the commodity concentrated areas of growth, and therefore it's also a very good leading indicator for commodity prices and Australia's terms of trade, income flows into the economy, etc. So as you can see, again, we've sort of had these three mountains, one at 2009, one in 2013, and then one in 2016, where China stimulated its slowing economy. And the most recent mountain, eventually, roughly 18 months ago, they started to press the brake, and the credit growth started to fall at a pretty good clip. As forecast, Chinese growth started to slow around mid-year and is still slowing today. There has been a slight turn, a 1 month turn in this chart, where there's been a little bit of growth in credit, but I still think that things are slowing rather than speeding up. That said, yesterday we had two important developments from China. One was Premier League Qing declared that China would see off the Trump trade war largely by infrastructure spending, and the NDRC, the National Development and Reform Commission, which is the super powerful kind of stimulatory central planner, if you like, in China, complemented that speech by announcing that it was going to accelerate infrastructure projects that were already on the table, as well as launching a whole bunch of new ones. So that is a classic signal that China is hitting the gas. When the NDRC comes out and says that, then you know that they're about to build. The infrastructure boom that we had from 2016 through 2016 and 2017, which is what lifted the Australian dollar from its last big swoon, was quite big, and infrastructure construction took up a lot higher percentage of the overall commodity demand in China than in previous cycles. I don't necessarily think that we're going to see that level of stimulus this time around. They are still trying to deleverage as well, and so for instance, local government spending has been waning quite a lot, and they're still trying to tighten up on that. That said, we've already seen quite a lot of money market loosening from the People's Bank of China, the PBOC, and that sort of started happening 3 or 4 months ago, and that immediately landed on the real estate market in looser monetary conditions. And so we're suddenly facing the prospect of a 2019 where we will have both runaway Chinese real estate prices driving ongoing construction, and renewed infrastructure spending. Now, the headwind, of course, is the fact that credit has been slowing. The credit impulse has been negative now for quite some time, so they've got to address that. But also, the trade war is probably going to knock somewhere between 0.5% and 1% off GDP as well.
Right.
So to some extent, this is a stabilising measure rather than an outright growth measure, and that's important, to consider in terms of how influential this could be in going forward for commodity prices, Australian growth, and the Aussie dollar.
And it's probably also worth noting as well that we can see those sort of the three mounds there, and in a way, while the percentage changes is getting smaller each time, the absolute growth is quite large in debt because the debt pole's bigger.
That's right.
And the economy is bigger each time. So the actual dollars coming on is still quite large.
You're growing from a higher base each time.
Yeah. But the effect it's had on the Australian dollar and commodity prices, iron ore in particular, has been less each time. So the initial one was, admittedly rescuing iron ore from the depths of the financial crisis was sort of like a, I don't know, 300, 400 times increase in the price. And
I don't know. I can't remember what the GFC low was on iron ore. Was it?
Yeah. 50-ish, 60. Yeah. Anyway,
I can't remember.
But it was significantly each time. I guess the effect on the iron ore price has been less and less.
Yeah.
And so while
that first boom we got to sort of $200 in iron ore. The second one we almost got to 100.
Yeah.
The second one we got. We were still short of iron ore at that point. We were still hovering up around 190, and then the third one we only got as high as 100.
Yeah.
Coming off 40. So I mean, my outlook for next year, based on renewed stimulus and these various inputs, is $60, $65, and we're already there. We're already past it. Like, markets have been pricing this for months.
Yeah.
So you're absolutely right. It's a law of diminishing returns for the bulk commodities on this.
Yeah, and for the Chinese economy as well.
Oh, absolutely.
Yeah.
Yep.
Okay, no problems. So we'll just we'll jump into the next one, which we've got is I've got a chart here of the terms of trade.
So I mean, this is a way of capturing what it means for Australia. Those Chinese stimulus pulses. This is the terms of trade. I think it's import divided by export prices, I think, or something like that. I can't remember the precise formula, but as you can see, we had a huge correction during 2014-15. That's when China really kind of tried to rebalance and let its real estate market go, and it deflated for some time. And then out of that, we've had the last 2 year big lift in commodity prices, nowhere near as high as they were during the peak of the boom, but still very high historically. And we've had a few bounces around that peak since. And next year, I think that we're going to stay largely up in this current range.
Okay.
Down a little.
Yep.
But as you can see, we still anticipate that beyond that, inevitably, this will revert to mean.
Yeah. And actually, just to put this in context for anyone listening on the podcast, so what we're showing is sort of a very, very long-term graph of the terms of trade, where it sort of hangs around at a sort of about a 70-ish level for, where are we, 50, 60 years. And then we've had this sudden spike. Well, we had a spike during the early 2000s as the boom happening in both China and in the US housing boom. Then a sharp fall as the financial crisis hit, followed by an even larger rise as this renewed Chinese infrastructure came on, and then as that came off, it sort of fallen away but then bounced back with the latest sort of 2014, 2015 set of stimulus.
Okay.
But also still well above its long-term average.
Yeah. So the immediate outlook is for the terms of trade to remain solid. Is the takeaway for the current sort of Australian dollar outlook.
Okay.
And I've just moved on to the next chart, which is I've thrown this one in because in case people are sort of wondering how long China can continue to build like this, and why we see iron ore and coking coal still declining, because you just never know how long the Communist Party can keep this up. Because as we've discussed before, they're actually reaching the point now where they're just knocking stuff down that they only just built and then rebuilding it. So they could go on, more or less forever. But that commodity prices will fall anyway, and this chart tells you why. This is the rise of scrap metal in China. So the red line is the percentage use of scrap into the Chinese output, and it's just rising inexorably. And so even if China builds like this forever, as the scrap component, which will be driven a lot by environmental regulation in China, like the battle against smog, as well as it's just a natural kind of progression because it's cheaper to make steel that way for the most part.
And where you came from in China was, if you're knocking down a hut on a farm somewhere, and then you're putting up a high rise in the city, you need a lot of steel, and you don't get any steel from the hut, and you need a lot of steel. But as you're getting to the stage now where you're starting to knock down high rises that were built 10, 15 years ago, and stick up new, bigger, sort of better built high rises, usually you need less steel because they're more efficient, but also you've actually got. Yeah, so you've got steel from the one you knocked down, and you get to use that in the version you're sticking up. And then same with cars. The car ownership in China has taken off, and you are getting to the stage now where you're starting to get cars getting scrapped, whereas you didn't have. I mean, so the number of cars getting scrapped now is increasing at the same rate as what we saw the Chinese car ownership rate increase.
And could there be an element of the fact that the recycling techniques are just getting more efficient as well? So the return back on what they can, like for example with cars, being able to pull them apart and
a little bit. Most of it's from the increase in the available scrap. So the rates of Chinese recycling rates are still well below. You could at least double and probably more the recycling rate.
Right,
to put them back on.
It's still coming. And they've got those mountains of O-bikes sitting out in the paddock as well as paddocks and paddocks of bikes they're probably going to have to dip into at some point. So that's right.
Yeah, well, that'll be a few apartment blocks. So the important thing to take out of this chart basically is this is the structural decline in Australia's terms of trade. And so the previous chart we talked about, we see being relatively stable after the stimulus announcement over the next 12 months, say over 2019, but the longer term outlook remains completely unchanged. This is a secular decline in bulk commodity prices, and therefore the Australian terms of trade. Moving on with our 5 drivers, where have I gone? I've skipped over one. So that brings us to the second major 5 driver and for our valuation model, and this one is unequivocally bearish at the moment still, and it's, as you can see in the chart, the orange line is the interest rate spread between Australia and the US. That is, just relative interest rates, how they compare. On this one I've got the 10-year bond, and it is now, it got into the minus 40 basis point range. It's come back a little bit today after the Chinese stimulus announcements, but we're talking about the lowest 10-year, the most negative 10-year spread since about 1984, something like that.
Wow.
So what this means is it's just incredibly cheap to sell Australian dollars, and very expensive to own them. Because you can borrow in Australian dollars and go and stick it in a US bank account and make money. So it's a reverse of the classic carry trade. And what David's talking about there is for 20, 30 years it's been you borrow in Japanese yen or US dollars and then just invest the money in Australia with the idea that you just pick up an interest rate differential on between. And now it's gone in reverse. So obviously that is a negative, a very strong headwind for the Aussie dollar, and in recent times it's gotten more and more strong. If you look at the blue line there, you can see in trend terms the 10-year spread and the Aussie dollar are very, very closely correlated. Not in the amount, but in the trend, absolutely. So that gives us, in our 2 drivers, we have an improving support coming out of the terms of trade with China stabilising growth for next year. We don't see it running off because of the trade war headwind and then the offset with the stimulus. You, all things being equal, we'll just say that roughly cancel one another out. It could be a bit more at a certain point or a bit less, but over the year we'll say that, and so we have a bit of a support in that one.
Having said that, though, that's a lot stronger than what we were expecting.
That's right, and
6 months ago.
That's an upgrade from when we were talking about it in May. And then the second one remains very negative. However, of course, because of the first one, and we've already seen this today in some bond yields. The Australian interest rates will rise because of the better terms of trade as well. Like the bond yields will, the cash rate won't.
I was going to say, yeah, might need to.
No. Like there's no moving in the cash rate. That people are kidding themselves on that. With house prices tumbling and we've got the credit crunch and what have you, that's not coming. But we've got these two very strong forces, one to lift and one to lower the Aussie. So moving on to driver number 3, which is sentiment. And just the easiest way of capturing this is the sort of relative position of the market as recorded by the CFTC. And at the moment it's moderately bearish, moderately to a bit more than moderately short the Aussie dollar, which in the short term you would say is probably bullish for the Aussie. The last time we were talking in May, it was neutral, and so there was no position in the market to unwind either way. It was poised to move with fundamentals, whereas at the moment the market's quite short the Aussie, and we can see it's gotten quite oversold in the last kind of 3 months as it plunged towards 71 and just below. So that suggests that if there is an improved outlook for the Aussie, it's not priced. Because the market's short. So that
and some of the recent rise we've seen is people buying back their short positions.
Absolutely.
On the back of these Chinese announcements.
Yeah, I mean the Aussie in the last 2 days has been almost the strongest. It has been the strongest developed market currency. Not as strong as some emerging markets, but strongest developed market currency. And this is why the market was quite short, and and then China sort of said, okay, we're going to hit the gas a bit, and so bang, they unwind the shorts. And so that's what's driving the recent lift, and that suggests it could run higher, for a little while. So that's driver 3, and sorry, moving on. I'm fumbling around
I've
here
got
on the computer.
The technicals.
Technicals, yeah. I mean, this one is voodoo, of course, but traders do use it, and so it has its own kind of circular usefulness. And if you look at the Aussie dollar versus the US at the moment, it's still a very bearish pattern, chart pattern. We've had this big fall from the height of the commodity boom, and then quite an extended rally, as China stimulated through 2016-17. And that's formed what is called a bear flag, which is now violated to the downside. I'm using the monthly chart here. That suggests that there could very easily be further downside. In fact, the chart probably suggests going back to the lows from 2015.
Wow.
So the chart's still bearish, basically. Like we could rally 2 or 3 more cents in the Aussie without really undoing the chart damage, as it were. So that's a negative, if you like, for the Aussie. And our 5th driver is the US dollar, and the relative value of the US dollar. And so that is a subject all of its own, of course, a massive subject all of its own. I've just given you the chart here, which suggests that it's still in a rough uptrend, the US dollar. Whether it stays in it, this is the $1 trillion question for the global economy at the moment. There are reasons to think that it will, and there are reasons to think that it won't. Fundamentally, what's been driving it up is simply, what we forecast earlier in the year, which is, US decoupling from global growth. The Trump boom, which has now got wages growing reasonably well, tight labour market, of course, and the US growing at sort of 3.5% or 4%, driven by big fiscal deficits in the form of tax cuts. Good consumer spending, reasonable investment, all of these things delivering solid growth, and much better growth, more to the point, than anywhere else. And as well, earnings per share, massive earnings per share growth, so booming stock market, etc. That seems to have its own internal momentum for us at the moment. We still think, because even though the tax cuts are a very temporary kind of way to trigger growth, because of the timing of them late in the cycle, when the labour market was already starting to tighten, it has triggered some wage growth, and then you almost get into a virtuous cycle where wages growth delivers consumption growth, which delivers top line growth for corporates, and that offsets any higher wages, and triggers investment on the supply side. Which in turn delivers more jobs, and then you back to wage growth. So there is this nice kind of cycle developing, late cycle kind of momentum developing in the US. That said, there is this fiscal cliff coming as well, where a lot of the fiscal deficits roll off, and so that becomes an automatic headwind from about mid next year. So determining the outlook for the US dollar, US growth first of all, and the US dollar at this moment is a bit of a flux. There's a lot of bearish commentary around the trade war as well, and what that will do to US growth. We don't buy into that at all. We don't think that tariffs are about to disrupt investment. We think inflation's low enough that it won't disrupt the consumer either. And
the rising US dollars offset a lot of the price gains anyway, price movements anyway.
It has, yes, and that's the other driver. Like if you're going to put in tariffs, you're going to expect you're going to have a bit stronger inflation, and that's one of the reasons why, if you're doing them, they may just backfire on you. And that is an area where you could you can see tariffs forcing slower growth in the US, is if the US dollar continues to rise, which by rights it should. But it may not. These things are all relative. So on balance, we think that the US dollar will remain firm. The risk in it is the fiscal cliff that comes in. It starts to kick in mid next year. We still think that there are a couple of risks short term. Of course, event risk going into the end of the year with the midterms, that might weigh on the US dollar, as well as who knows what Trump will do next on the trade war. Although it seems we've got a bit of a hiatus now until the ratchet mechanism in the new year, which would lift the current tariffs higher if nothing's done, which now seems inevitable. So possible short-term headwinds for the US dollar, especially around the midterms. If the Dems win the House, there'll be some rumblings about impeachment, etc. Although we don't think that that's a realistic scenario or likely. And then you get into next year, and the fiscal headwind that is obvious to everybody who understands these things. Trump is going to have to do something to offset that as well. So we actually think it's very likely that they'll look for more stimulus as well, along the lines of what China's doing, more infrastructure, because the US really needs it a hell of a lot more than China does, quite frankly. But that's kind of looking across the valley a bit. So there are risks to the US dollar, we think, in the short term, but on the balance of risks, we think next year it probably is still strong. Okay, so where does that get us? Whoops. So summarising then, China's growth is going to be hit, 0.5% to 1% by the tariffs, as we'll see, trade diversion to other cheap emerging markets.
Do you think we'll actually see that growth hit, or do you think it'll just be erased out of the ledger?
Well, it's going to be erased by stimulus anyway, so doesn't matter.
Yep.
So moving to fiscal.
Well, it matters in terms of the sectors that it's in.
It does.
Not
Not the headline figure.
The headline figure is that with a trade war on, is that China wants to spend some money to make sure that their economy isn't going to be. That's what the whole announcement, sort of overnight, was about. Was saying they're going to spend the money to make sure that they're not too negatively affected by the trade war.
Mm-hmm.
Look, they were trying to deleverage when this started, and so in the short term, the trade war has done Australia a favour. Because we were looking at less commodity intensive growth over 2019.
And infrastructure had gone negative.
Infrastructure had gone negative, and they are still tightening on the property market with macroprudential, so there's a possibility that would slow too. But the trade war basically, has given authorities, it's spooked them into more stimulus. So we're going to see, let's assume that their deleveraging had gone fine and they'd managed to rebalance to more productive output than building over next year, and they managed to sort of keep the economy at 6% or more growth. Instead of that being productive now, it'll just be more unproductive stuff, and they'll keep the level up, and it'll be more kind of commodity intensive than it would have been.
And part of the way that China accounts for these is that they'll knock the buildings down, and that's sort of without write-offs within their GDP, and they'll put up a new building, and that will add to GDP. So the net effect might be, had 100 apartments, now I've got 150 apartments, but that it doesn't come in as a net 50. It comes in as a 150 into the
it's plus because you've got to pay someone to knock it down and then pay them to build it again.
Yes.
Yeah, that's right.
This the next point here is, will the yuan keep falling? This is very, very important too. This is a difficult one for the simple reason that, when Lee came out yesterday and said, no, the yuan won't fall, we won't, in inverted commas, weaponize it. He said that in the first sentence, and then his second sentence was, we're going to stimulate, right? So those two are completely contradictory, right? So he's basically saying we won't officially deflate the yuan, but we are going to deflate the shit out of it by...
we'll allow investors to deflate it
for
us.
Well, yeah, that's right, because we're going to ease monetarily and fiscally. So, most people still think that there'll be more monetary easing. I don't know, I'm a little bit torn on that at this point, because I'm just watching the real estate market already go nuts, and I'm wondering how much more stimulus they really think they need. But if there is, the yuan will fall. I can't find at this point a very bearish or a very bullish case for the renminbi. The jury's out at this point. So that gives us to our next point, which is the 2016 parallel, and by that I mean, we saw the similar episode coming through 2015 with the US tightening, China slowing and deleveraging, commodity prices getting routed, and then China hitting the gas in early 2016, and the Aussie dollar jumping from 68 to 81 over the next kind of 18 months. The dynamics are the same this time, but they're different as well. Commodity prices never crashed. Most of these booms already priced. You've got the US boom going. The Fed was not going to stop its tightening in the immediate term, and I think the Chinese stimulus will be smaller as well. It'll just be enough just to not look like they're losing the trade war, because they're aware of their structural problem with too much debt. So I don't think it's 2016 parallel. It's kind of analogously similar. But in terms of the Aussie dollar, I don't think we're going to see that kind of rise. Unless, probably, if the only scenario in which I could see the Aussie really getting going is if China keeps its foot to the floor, and the US, for one reason or another, probably politics, falls off its fiscal cliff. then you would have a strong China and a rapidly slowing US. In that event, the Fed pauses, maybe even cuts, and the interest rate spreads to Australia start to contract. And so then you'd have the terms of trade and the interest rate spreads lifting the Aussie. But that's not my base case at this point. So to summarise everything in the 5 drivers, we see short-term Aussie strength on the back of being oversold, on the back of Chinese stimulus.
Yep.
On the back of some of those spreads coming in a bit. But in net terms, we think 2019 it will remain weak.
Okay.
So it's just kind of short-term stronger.
Yep.
2019 remain weak. Not as weak as we thought it would be, but still weak.
Okay. Very good. We've got a quick question that's come in as well. Do you think there's an opportunity to short the AUD given that most institutions are forecasting a rate hike in Q2, Q3 of 2019? That's out in the boonies, but...
well, I do think that they're all wrong. So if the market's priced off that, then yes, there is. But I'd be cautious. As I say, I think that there are some short-term tailwinds now for the Aussie. But I think they're absolutely off their rockers if they think there's going to be a rate hike next year. I mean, you're talking about a rate hike going into a federal election, if nothing else. The federal election is going to stall everything. It does every time. But in contemporary terms, especially so because they're so conflicted, and the policy positions are so problematic. And this time, you're going to have Labor winning in a landslide. I think that's pretty clear. And you'll have negative gearing reform and housing markets taking another leg down. So, you'll have a swift slowing of the economy into the election. You'll have a housing market shock coming out of the election. Even though China's stimulating at the moment, and will be, in terms of trade, will be a bit stronger next year than we first thought, that I'd still say it's odds on for a rate cut.
Yep.
Because the mechanism by which that commodity income used to flood into the economy is broken. It used to come in through three paths. One was the budget, and big tax cuts, and the budget is going to boom. There's no doubt about that, and we will get some tax cuts, I think, next year, but not until late in the year once Labor's in and got its feet under the table.
Yep.
Secondly, it's through the stock market and just the miners rising, but because the AUD has become so sensitive to all of these inputs, that gets short-circuited now, and the rest of the bourse just gets smashed when the Australian dollar rises. So I don't expect the share market to go anywhere on the back of this.
Yep.
So lots of movements in stocks, but just not in the aggregate.
Not in the aggregate. And the third one, of course, and this was always the big one, was when prices rose materially, there would be a follow through of investment, into more mines.
Yep.
Now we've seen a little bit of that right now. We're seeing a bit of that from the major miners in the Pilbara, but not because they're short of iron ore, just because the anti-smog measures in China have driven a big divergence in price between different qualities of iron ore, and so they're all digging up better iron ore, basically.
Right. Okay.
And so that's triggered a reasonable little wave with some new mines, but there'll be no more, none. They're massively overbuilt still, and so there'll be zero extra investment.
Okay.
And so, even though the miners get flush and the budget gets flush, households don't. And when you've got falling house prices, we will eventually get some tax relief, which will help at the margin. But wage growth going nowhere, and if anything, I think wage growth is probably peaking now and will start to soften again.
Wow.
Because I think labour markets will weaken next year.
Yeah, right. Even under a Labor government.
Yes.
Yeah. Okay.
Well, anything they do to readjust the balance on industrial relations will take years anyway.
Mm-hmm.
And they're very pro-immigration. So that supply side shock won't stop. So I don't think I see a great outlook for wages, a very poor outlook for Australian inflation.
Mm-hmm.
So, whether the RBA actually is forced to cut, who knows?
Yep.
But they sure as hell will not be hiking next year, and most definitely not in May.
Okay, thanks for that. And we've got just one more. It's a little bit of a follow-on, I guess, to the shorting AUD question, which was if you were to short on the basis, obviously, that you're expecting the AUD to continue to fall at some point. Do you think there's a better pair than the USD?
The Aussie yen's been going quite well from memory. Look, I'll be honest. I'm not looking at those crosses on a super regular basis. I would have thought, if you're going to sort of use interest rate differentials as the prime driver, then you're probably still sticking with the US.
I think it's safe to say we're still quite. Our longer term views haven't really changed. It's a question about saying, if these things, if we're talking about long term trend down over 10 years of the Australian dollar from its sort of highs in $1.10 or whatever, and we've sort of hit the bottom of the downtrend at the moment, and we can see some short-term issues as to why it might rise. Mm-hmm. And then the question, over the longer term, do you still want to be on this same? Absolutely. So we're certainly not making wholesale changes, not talking about making wholesale changes to our investment ideas, but as a short-term sort of tactical moves, and whether you're when you've just had a decent downdraft in the Aussie dollar, do you now load up and go again with it, or do you wind back a few of your positions and keep your same sort of net negative outlook, but you're not as negative as you were when the currency was sort of 76,
yep.
And then you're waiting for the next sort of uplift and a few of these things to come good before you then load into that trade again.
Okay, yep, sure thing. And just another question, sorry, has popped in, which is that do you see 70 cents? So I'm taking this as AUD USD. 70 cents at the end of the year as possible, and then mid 60s, and then end of next. Sorry. What are your sort of, if we're going to pluck some figures and times out of the air?
I've got 72 on it now. Originally I had 70, and then I lifted it a few months ago when we saw this Chinese stimulus coming. Mm-hmm. So I'd stick with that.
Yep.
Possible. I think probably the risks to that might even be a little bit to the upside at the moment. Mm-hmm. But then, that said, 2 weeks ago they were massively to the downside, so things can change very quickly. Next year, I think, look, not as negative as I was, because China is going to be stronger, and the mix of growth more favourable to Australia. I was originally pegging it at 65 by the end of next year.
Right.
I think probably high 60s is more realistic now.
Okay, and just as a follow-on, what would you do? What would happen when the USA potentially falters 2019 as re the AUD? So,
well, I mean, if we see the US faltering, then obviously we'll be revisiting our allocations. But at this point, we don't think that's the base case. Although it's obviously, to some extent, an extrapolation for us to say that we think Trump will turn back to infrastructure stimulus.
It remains to be seen.
Well, yes, it remains to be seen, but it's a very logical position. there's a presidential election in the US in 2020. Donald Trump is Mr. Boom. He's Mr. America First. He simply cannot allow the economy to slow. If there's one thing he cannot allow, it is that. Especially in the middle of a trade war with China. I mean, it would be catastrophic for his basic, regime. So
and as well, to his credit, I suppose, you'd say is that he ran on a number of things that he said he was going to do, and he's doing them. Like whether they're good or bad, he said he was going to cut taxes. He said he was going to try and clamp down on immigrants. He's on both those. He said he was going to get stuck into China for about the unfair trade practices, and he's doing that. And so the last thing he's got on his list is infrastructure and building a wall. But if you treat building a wall as part of the infrastructure, or as just being particularly, if it's a metaphorical wall about what you're doing to immigrants and things like that. But he has been doing what he said he's going to be doing, and so it does make a lot of sense for that to be the final piece. And it also makes sense if you're going to be pushing stuff, to be pushing the trade things and tax cuts and everything like that early while you have both the House and the Senate. And then if you lose one or both, then the Democrats are still going to be likely to want to do things on infrastructure. So
that's right.
Probably get some votes still.
Exactly. And I guess the key is everybody can see it coming. Like the fiscal cliff and what has been a tailwind turning into a headwind. Like it's not going to shock anyone. So I mean, it will need to be addressed, and I think they'll address it. Now, the fact that the inertia is for a slowing US in the second half of next year, to some extent, means that there may be some volatility around the question. Because some people will obviously be able to take the opposite view, and that's a market.
Yep.
So, potentially that's another headwind for a rising US dollar over the short term as well, into the event risk of the midterms. But that's our solidly reasoned based case, is that the US will turn to more spending to keep the economy ticking over. Now, the interesting question, if they do that, is what happens next. And given the tightness of the labour market, the fact that they'll have tariffs, a little bit of repatriation of production, some more inflation, they've got a nice little virtuous cycle going with wages.
Rate hikes.
Yeah. So if they do it, 2020 bust becomes a real possibility as it drives the Fed up.
Yep.
And instead of us getting 2 or 3 more hikes, we get 5 or 6. And at some point, that just blows up the stock market, and bang, end of cycle shock.
But for us, US dollar to the moon.
In the interim. Yeah.
Okay, very good. All right, we'll jump into the investment impacts as well. So we've got we've got the selection there from our thoughts from May 2018, and we've brought in now, of course, September's thoughts. Do you want to kick us off, Damien?
Yeah, so quite different, I think, in terms of the is the summary. It's most of these around the short-term issues, though. Again, so as opposed to the longer-term issues. So in May 2018, we had world reflating on a falling US dollar and monetary tailwind for emerging markets and commodities, and that's basically turned completely on its head. So the rising US dollar is now a monetary headwind for EMs and commodities. By the middle of the year, we were expecting to run into sort of the fundamental headwinds, and they sort of came through. But now we're still expecting some weakness in the short term, but all indications are at the moment that China is going to unleash some debt. That'll take a little while to actually to get some traction.
Okay.
And also they are going into some winter shutdowns as well, so that's coming up pretty soon. But having said that, we are expecting that China to slow a little bit, and then to unleash. And as David was saying, that even if the growth itself doesn't change markedly, where the growth's coming from will change significantly, and back to to the things that benefits Australia.
So from a portfolio point of view, locally, I guess we've got essentially the miners. Is that an area of interest given the prospective infrastructure spending?
Yeah, so we've been picking up some miners in recent weeks, sort of adding a little bit to that. So we're looking at the prices and it's always the problem with it always is, as David was saying, that a lot of the commodities have priced a lot of this in already. So in some of the last episodes, we saw the iron ore price fall from sort of $200 back to sort of the $50, and then it shot up again, and then it came back down again to sort of $30. Did it bottom at $38? Bottomed at before rocketing again. So at the moment we're still in the 60s. So the upsides
70 now, but
yeah.
It's fascinating what's happened to iron ore. Iron ore is now the immediate buy the moment there is a ruffle in Chinese politics. Like, it prices this stimulus 3 months in advance.
Wow, yep. Because they just know they're just going to pull the infrastructure lever every time.
Yeah. It's as predictable as the sunrise now.
Yeah. So the question is around those is just about the pricing. And so that's where we're playing around a bit. We think the terms of trade holding up and spreads not getting that much worse. Some of that downward pressure on the Aussie dollar has been relieved now, whereas we were expecting the opposite, which sort of came to bear. And part of that was then as we sort of reached the close to 70 cents Aussie versus US, we sort of closed out a lot of our positions in currencies and just some of those cash holdings we've sort of flipped back and closed out some of our we're still overweight bonds, but we closed out some of we're very overweight in some areas, and so we've sort of closed some of those off. So I guess strategically, I suppose we're still on the path of saying yes, we're still playing for these longer term trends, but at the margins we're playing around with the weightings just to acknowledge that that most of what we were expecting came, and the situation has changed. We still think it's a momentary blip, and it'll last sort of 6, maybe 12 months. But it is there is an expectation that the positions we were holding 2 months ago are not appropriate once prices move and circumstances change.
So essentially this, and I guess then looking at internationally, it gives us a chance, or essentially a bit of a breather, so we can go back through the the dollar play as opposed to, I guess, the company sort of side. Not to say that there's those two combined anyway, but to then say trim back, take a bit of money off the table.
We'll take a little bit off the table. There's swings and roundabouts, and part of it comes to the types of companies you want to buy as well, and whether, because you're still looking for this exposure to the US, and we don't want to get caught as well that as David said, we're sort of looking at across the valley for a little bit, and saying things will come back to our core themes. Is you don't want to be caught sort of jumping one way to say, oh look, there's a short-term issue, let's suddenly jump over to one side of the boat, only to find that events move faster than you expect, and all of a sudden your longer-term themes that you've sort of positioning your portfolio are all coming earlier than you expected. So I think there's a key part to saying it's a little bit of movement, but you shouldn't be making some sort of wholesale changes on this unless you sort of had a view that this was the start of a whole brand new regime. We think it's just the same regime is continuing, but it's it's hit a certain stage of that, and it's also the other part was that you can still come up with some pretty bullish arguments for stock markets to go particularly strong over the next little while. So China's got its stimulus, it ramps it up, turns into an even bigger stimulus. Maybe we then see the US come out earlier than we expected with some of the infrastructure spending, and that sort of pushes the growth there. And so all of a sudden you've got these big two booms going on. World growth, company earnings all booming away, wages picking up in the US. Virtuous cycle that sort of flowing through to Europe. So you get some of the demand from the US is sort of seeps through into Europe and lifts things there. You can paint some pretty bullish pictures over the next 12 to 18 months of this sort of global synchronized boom from all this debt driven. So it's not a sustainable thing, but debt driven spending from government. So you don't want to be caught too bearish on this.
Yep,
But
yep.
yeah.
Okay, very good. All right, fantastic. Well, on that note, let's find out a little bit more about Nucleus Wealth.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Well, I hope you enjoyed today's presentation. I certainly did. And coming up next week, same bat time, same bat channel, Thursday the 27th of September at 12:30 Australian Eastern Standard Time, we have our next instalment, which we're going to be looking at Australia's little financial crisis. Sounds intriguing, and I urge you to check in then. Of course, as always, we're shooting these live, so if you'd like to get your questions answered, as we had a couple of great questions there today, please head over to proton.nucleuswealth.com, register your interest, and then we'll send you the link for to check it out and to view it live. So on that note, thanks very much for your attention today. And if you are listening in or watching us on YouTube, be aware that we do also put this out as a podcast as well, available on all major podcast vendors, iTunes and Podcast Addict for anyone on Android. And if you do like what you hear, please feel free to give us some reviews or some stars or whatever it is that the podcast app allows you to do to show your gratitude, as it helps us move our way up the rankings and obviously get more viewers and drive exposure for the show. And just finally, as always, we do have a survey that you can fill out. It's at bit.ly/Nucleus survey. It just gives you an opportunity to give us a bit of feedback on how we've gone today. But of course, also you can post up any potential future topics you might like to hear about. So on that note, thanks very much. Excuse me. Thanks very much for attending, and we look forward to catching you at the next one. Cheers. Did it come through all right?
Yeah. So